Welcome back to the channel. I'm Ozbourne Foreman, and today I'm going to be giving you 3 reasons why I lost money investing in stocks and shares. And if you like this video and think it delivers more value than usual, then drop one of these, as it does help with the YouTube algorithm. Just before we start, I've got the hiccups at the moment, so I might have to pause a few times, but I'm hoping we can power on through it. So there are 3 core mistakes that I've made recently or over my time period investing, and if you're a loyal viewer on the channel and you know that I upload content, my portfolio updates on a weekly basis, you've likely enjoyed, or not enjoyed, but joined me on the journey. If you enjoyed it, perhaps then there's an entertainment value of what I've done. But what I hope for truly is the value in avoiding the mistakes that I've personally made. Now, that said, the first mistake I made, and one of the core reasons I lost money investing in stocks and shares, is FOMO. FOMO stands for the fear of missing out. What happened here is I saw some attractive stocks, I saw them rising in price, and I thought, you know what? I really need to buy this stock right now. I'll justify why later. Obviously, in my mind, it wasn't like that. I saw this stock, it kept going up. I looked a little bit more into it. It sounded exciting. I looked at it a little bit more. Oh, the stock's gone up another 5 or so percent. And I'm a little bit more engaged here. I'm like, I don't want to miss this out. This could be going up another 40% the next few days, or well, the next few months, really, is what I felt on that. So, yeah, I wasn't completely deluded. But there was a small, minor, tad bit of delusion there at the same point. Now, a prime example of this would be my investment with Argo Blockchain. Now, if you don't know who Argo Blockchain is, it's probably for the best. But what they were, or they still are technically, a Bitcoin cryptocurrency miner. They were the first cryptocurrency miner, or the only, listed on the United Kingdom or the London Stock Exchange, and that was their real claim to fame. Now, the value here was that we saw this investment. Someone like myself was going, wow, look at the people, or look at the companies on the NASDAQ. Wow, you've got Marathon, you've got Riot Blockchain. Look at the valuations they're trading at. Well, actually, Argo Blockchain seems to be mining a similar level of Bitcoin, or arguably, at the time, they had a higher Bitcoin mining margin, which was greater than that of Marathon and Riot. So I thought, oh, this is good. This is an opportunity here. There could be some value. And you'd see the share slowly push up, and it push up even more. This was a really volatile stock. And I think by the time it had caught my attention, it had gone all the way from about 7 pence to about 30 or 40 pence. So I was obviously missing out on a lot of the gains, but I thought, wow, it's gone 3-4 times up in value. I need to buy this. I need a share. I need a slice of this pie. I want to get these gains too. Now, again, I wasn't this deluded when I invested, but I was foolish in the fact that I invested in something I didn't completely understand, primarily because I thought it would have been a good investment opportunity because I saw it going up. And then what I did is I went and justified the share price movements and gone, oh, okay, this has gone up, therefore it must be a good company. And then I would read the RNS or their reports with a bias. I'd go, oh, this is a great company, and it might be some red flags right in front of me. But because I'd already seen the share price go up, I was like, well, okay, must be a good company if the share price is going up like that. And therefore, I kind of had the fear of missing out, because what ended up happening is I bought a bit and it went up even more, and I was like, well, I've got to buy more. I'm making money right now. I need to buy more shares. And that instinct there is what really allowed me to build up a significant position relative to the size of my portfolio. And I can't remember the total number of shares because the value of the shares has been absolutely diminished since. But I remember I built up a position of about £7,500 in my portfolio, which, if you know the total value of the portfolio is about 25k, that is a huge part of that. And this was in such a short period of time. This position built up over a period of 4 or 5 months, and it took such a large stake. And subsequently, what happens? Oh, there's a few red flags in the RNS. The company's leveraging Bitcoin on short-term loans, and it all started going downhill. Fortunately, I cut my losses. Otherwise, I'd be sat on a much larger loss. But I did cut that loss at 50%, which is still a huge amount there. And this kind of ties on to, and this was a loss capital of about £3,500. But this ties on very well to the second reason that I've lost money. And if you haven't already, definitely click that subscribe button, because I post content weekly. I'm trying to do, portfolio updates that really matter, learning from it. What can I share with you, rather than just going, I hold this number of shares of this stock at this value. I want to add value. So if you like that, definitely click that subscribe button down below. So that joins me on to the second core reason I've lost money. And that is under diversification, or the opposite of diversification, which is I'm not diversified, I'm stupid, basically is where it should be. Now, I'd followed the quote, which was diversification is protection against ignorance. I'd only followed 3 of it. No, I didn't follow any of it, to be honest, because if I'd have followed the first 3 words, it still would have been diversification is protection. But if I'd have followed the last few, well, clearly I was ignorant in that period. My point here is what happened is I had poor risk management overall. I believed that by holding a very small number of shares, I could maximize my overall gain potential. And at the time, that sounded like a great plan. I was like, well, I could have 60% in this one stock here. If this one stock goes up by 8%, well, I've seen a fantastic gain of value in my overall portfolio. However, this is great when you look at how much your investment can appreciate. Not so great when you realize how much it can fall. And that is a lesson I had to learn quite badly. But let's discuss this, right? So I've had some good winners in the portfolio, right? Ashtead Group, a company that I held probably about 1.5 to 2 years back. I managed to more than double my money on the investment. I bought at something around about £23, £27 a share. Well, that's where my weighted average got to, because I was buying at an earlier stage when it was a little bit lower than that and in the teens. So I was buying that, really building up a position. Unfortunately, it wasn't an exciting enough prospect for me, so I wasn't building up a big enough position, hence the concern here. So this under diversification element here is where I bought a small stake relative to the overall size of the portfolio, which meant that realistically my gains in Ashtead, whilst good for a 120% gain, I sold at something like £50 or £60 a share, so I did very well in that regard. It wasn't a big portion of my portfolio, therefore, obviously, I didn't make much. That was the issue. Whereas on the contrary, I had big losers, like Argo Blockchain mentioned earlier, for my mistake of the fear of missing out, taking up a large portion of the portfolio, which negatively impacted my overall. So I'd gotten some great gains from Ashtead Group. I made about £1,800 or something like that. I'll have to double check that at a future point. And I'd made, £1.5 grand. Let's just say £1 grand. Let's just assume it's the worst. I made £1 grand on that investment. But I'd easily lost that because I didn't diverse myself well enough in my stock universe, and I had poor risk management because Argo Blockchain lost £3.5 grand. My great gains were wiped out by one stock and more. This goes on further. Now we'll talk about my biggest mistake overall, which, risk management is definitely a key mistake, and that's definitely contributed to a large part of my overall losses. But, right, my risk management, or my lack of diversification per se, would have been acceptable if I had been more disciplined in my investing purchases. So when I was buying shares, it would have been far greater if I had just decided to be more critical, more analytical, and really examine every single investment opportunity. Instead, I went for the approach of, I'm going to do the research up front. I'm going to find out that it's likely a quality company. I'm not going to think too much about valuation, and I'm just going to keep piling money in. This mistake, I would say, is a lack of discipline when averaging down in an investment. Now, they say don't catch a falling knife. Don't fall for the gambler's fallacy. Keep adding money on a loss. That's not good for you. And I was aware of this at the time. At least aware enough to go, I'm not gambling, I'm investing. Or so I'd thought. Based on my current knowledge at the time, I thought it was investing, but perhaps I wasn't. And a good example of this is my investment in Boohoo. So we'll look at my portfolio here. You'll see that this is the total value. And you can see that overall it's down by a huge amount relative, right? So huge, in fact, I didn't even say. But we'll look at here, Boohoo. The overall position is down 59%. And this is because, and I'd bought this stock about 3 years ago now, something around, or 2.5, 3 years ago. And I'd bought just when they had hit the modern day slavery allegations. And I was starting to buy, I saw it at £2.90 a share. I remember that day very well, and I was like, this is a cracking company. I really like the growth prospects here. This is fantastic. And it dropped even more to £2.30 or £2.17, in fact. And I was like, right, I need to be buying on this. And at that time, I think I bought 1,000 shares, something very small. And it rallied up really well, right? And it got all the way up to about £4 a share. And this is great. I thought, wow, look at those returns, fantastic, good movements. And I carried on buying as I saw the share price drop down. I was like, it's £2.50 a share. This is a bargain, because obviously it was £4.40 at its peak, right? I'm like, I'm buying, this is a bargain. And what really happened, where this happened the most, is about April 2021 onwards, right? I kind of held off. I bought a little bit here and there, maybe a little bit here every week as dollar cost averaging. And then about July, it dropped to about £2.60. And I'm like, wow, this is an opportunity. I could buy here. There's blood on the streets. I can make some good money. And what happens? Well, it goes and drops again in October, all the way down to £1.86. And I'm like, oh my God, this is the lowest the price has ever been in the last few years. This is a bargain opportunity. We're looking at pandemic crash values here. Great, I'm going to buy. And what happened again? At the end of November, December, it's down to £1.20 a share. And it keeps going. And I'm just going to keep going and going and going until eventually it's dropped down to 50 pence a share, where it sits at today. Because I lacked discipline in my investment strategy, I allowed myself to build up a significant stake in this position. Look how much I've invested in total in this stock. The current value of £10,750. The investment loss of £15,500. That is the total value of my ISA portfolio today. Imagine what that value would have been, obviously in hindsight, if I hadn't have averaged down so fast. Now, the key lesson I've learned from this mistake is that even if a stock's dropping, it's wise to reevaluate the investment case. Now, I did this bit right. When the shares dropped by 20%, I was like, should I be buying Boohoo? Is there a fundamental change, or is there a fundamental reason for this decline in the stock? Okay, there's more fears over allegations of scandals. The suppliers aren't looking good. There's more cockroaches around. But that's okay. I'll buy a little bit more. And that was where the share price hovered above £2. Then they had some poor results. They had a poor trading update. I think they had a profit warning. And then I carried on buying, which is where the mistake really hits here, because what I should have done and what I've learned since is that, okay, if I believe an investment or a business has long-term growth potential, but it's having a poor period of time at the moment, well, I'm not going to try and time the market, because quite frankly, I don't have a crystal ball. I'm not only going to know where the bottom is, I'm not going to know where the top is, so why even try? I'm not going to stress myself out. But what I could do is go, you know what? Results are quite poor. I did believe in this business. I bought for a good reason. Perhaps my valuation wasn't very good. I'll chalk that up as a mistake. Shares are down by this much. That's fine. I'm now not going to buy any more shares of this stock unless things look promising. And if the outlook for the company looks dire, I will cut my losses and the position. Now, if I had done this strategically, I would not have had a fraction of the size of the current value of this position. Instead, I likely would have had a high percentage loss, let's say 80 or 90%, but a relatively small amount of losses, let's say 1 or 2 grand max, because I didn't allow it to take up 70% of the portfolio. Again, everything's 2020 in hindsight, right? It's so easy to go, oh, if only I'd have done this, I would have made loads of money. If only I had bought in the midst of the pandemic and sold when it was at a high in June. Of course, that's the idea. In hindsight, it's so easy. But with a bit of discipline, like I'm doing now, just going, okay, shares have dropped. I'm waiting for a positive trading update, something that shows that the company is seeing an improvement in trade. All of the risks that they've had over the last year and a half had been shared by the industry. Sentiment in the industry was subsequently low. However, I know that. I'm still going to wait. I want a little bit of promise. And even if that means Boohoo rallies up to 90 pence a share, because let's say, they've had some fantastic results, that is more acceptable for me, because then I can go, okay, look, the company's doing well again. Now I can look at potentially buying some more shares. That said, the position is so large in my portfolio, and if it recovers to 90 pence a share, it'd be huge. I'd probably hold fire on that case, but the option's there. That's the idea, and that's the concept if I'd have done it correctly. Now, for those of you that didn't know, I actually have a Patreon. I've not been marketing at all. I've got free stock watch reports, and weekly I've been writing a detailed analysis and giving my insights on specific stocks in the US and the UK. My most recent one was Tesco, but I do have a free preview available for Mastercard, which was the first stock watch report I've ever written. Let me just tell you this, it's a link in the description down below, but it's gotten so much better by the third one so far. I'll be marketing this a lot more as I've I've produced more and gotten better at producing it. And there will be some more free ones to come, but definitely check out the link to my Patreon in the description down below to have a little nose and have a look at that article for it. Thank you for watching. Have a fantastic day.